Well, Rob, welcome to another Rock Talk. And, as this is March 13th, so we're going to, talk about the market and where things are at right now. Obviously, the market over the last couple of weeks been a little rocky, been bouncing all over the place, overall on a downward trend. And, this episode of Rock Talk, we asked our listeners to send some email in their questions. And
most of their questions rhymed.
Yes, they did. They were pretty much all the same, which was, hey, tell us a little bit about what's going on in the market and, what should we do about it and what is Edrock doing about it? So thought we could, really hit on this theme and spend a few moments on it and talk through it a little bit.
Agreed. Do you want to kick us off with what your perspectives are on what markets are reacting to?
Yeah, I think the biggest thing, and we talked about this at our client event last Saturday, which was the market just doesn't like uncertainty. Yep. And most people don't either, right? And when you have the trade, the tariff piece, which is, hey, we're going to tariff Mexico today at 10% on a certain good, and then nope, it's 20% on this good, and
those headlines are just flying right now.
Right, they're all over the place, and that's going back and forth between Canada and Mexico, everything, right? And so that just causes uncertainty, and so the market's shaky about that. And when there's uncertainty, there's going to be a sell-off, typically a pullback, and that causes some angst. And what I'm, in the conversations that we're having with clients right now is a lot of families are kind of wound up on that a little bit, right? And that's fine, maybe rightfully so. But I think the biggest thing that I've always told families over the years on this is maybe be careful about where you're getting your news and the TV. How much TV are we watching? And now it's how much social media are we doing? How much are we scrolling on a daily basis? And maybe try to get some of that information from both sides. Listen to both sides. Try to hear everything, or maybe just don't listen to it as much a little bit.
I don't think anyone's ever made a great decision when reacting to something emotionally, and the same thing could be said when it comes to finances. Frankly, downturns are never foreseen. No one can ever predict the path of the market, but in some ways, I think market participants have been calling for something like this for some time. It's the old adage that valuation does eventually matter. We had been seeing these heady valuations on a lot of growth names. We've talked about market concentration here, and you're right. When you get a little bit more uncertain, and we did talk about this weekend, it's never necessarily the actual change that matters. It's the rate of change, that second derivative. And just when things get a little bit softer, all of a sudden those valuations look very, very shaky. And most algorithms out there that we see, traders, they're more likely to sell first and ask questions later. And I think that's a lot of what we're seeing right now.
Yeah, agreed. And I think I've always looked at this as bad news is a true investor's best friend.
It can be if you're contrarian. Yeah, absolutely.
Right? That, it allows you to make up ground over time. And it's something, I heard a while back that I liked. It was a great little quote, which is, whenever we have these downturns, that money transfers to the stronger hand.
It can.
It can. And you've got to be careful about that at times, about making emotional decisions. And there's a Warren Buffett quote that I've, said for years, and, which is,
here we go, slinging Buffett quotes.
Here we go. We're starting off Mr. Warren. So, when we get into that, which was, if you can't manage your money and remove that emotional piece, you really probably shouldn't be managing money, right?
Yes.
And so, with that, we've got to be really careful. And when we look at the drawdowns over the years, and this is a slide that we're going to add in here, which is on an annual basis, the drawdowns, are pretty significant that we see here across the board, going back to 1980. So 25 years of this, where the market's down, typically anywhere from 7 to 20% on an annual basis. Right now, we're down 6% as we look at the year. Year to date, we're down 6%.
Right.
Now, doesn't mean that it can't go down further when we're looking at this. Historically, whenever we have drawdowns, the average drawdown is about 13%. We're down 6% at this point in terms of just negative rate of return year to date.
Year to date. Hit correction territory on a couple of the averages.
That's right.
Today, which, as we've been talking around the office, there's there's nothing that we've seen from the markets that isn't out of the ordinary.
That's right.
I would say also markets are a pretty important forward indicator. So even unpacking what people are feeling anxious about, we can go through those. And we've talked about one, tariffs, the uncertainty there. We know that in some respects, it could cause a pretty dramatic one-time price increase. After that, the effects are a little bit unknown, especially when it comes to consumer behavior around those tariffs. But we've had a couple inflation releases, PPI and CPI. Maybe they were a little bit softer than what many economists were projecting month over month, but inflation's still there. It's still sticky. This isn't anything new. That could be causing some anxiety. We've also heard and seen data that suggests that maybe consumers are softening a little bit, maybe a bit stretched. Some of the earnings calls, especially out of consumer discretionary companies like Walmart, Dollar General, have cautioned against a slowing consumer. So this could lead to maybe something to pay attention to, but ultimately its path and depth are unknown.
That's right. And that's where I think having the right portfolio comes into play, right? There's always unknown. Whether the market's taking off and doing great and everyone's wondering, well, how long is this going to keep going? When's it going to drop off? Or when we're in a moment like this where there is some turbulence, again, how long is this going to keep going? When is it going to end? When is it going to bounce back? Through either of those scenarios, whether the market's going up and doing great or we're having some turbulence and volatility, that at the end of the day, having a properly allocated portfolio, and the one that is wide, we've talked about this a little bit, so maybe we want to hit on this a little bit, a wide portfolio. Maybe you can hit on that piece and how that really plays out in a scenario like this and how it's advantageous.
Yeah, and it always goes back to professional money management versus maybe someone that's just doing it on their own. A lot of people, and it's to no fault of their own, we're always just trained at looking at the headline numbers of the S&P 500, and it's actually like 507 businesses in the United States, right?
Yep.
And is that an appropriate metric in which to judge, well, what you need to do? Well, I mean, something that started with you here is, well, your allocation starts with your financial plan. So do you need to take S&P 500 risks solely in and of itself to accomplish your goals and what you want to do over your lifetime? The answer is no.
Yeah, I would say out of the just hundreds and hundreds of clients that we have, very few, small handful are okay with that type of risk.
Right. So how does that lead us to design portfolios here to accomplish goals set forth by financial plan? It means that we do have S&P 500 risk within the portfolio, but it's not the only risk that we're exposed to. You and I have talked about this quite a bit, but even in the public space, well, what does that mean? It means we have mid-cap allocation. It means we have small-cap allocation. We've talked recently about going even further in some global exposure in our larger allocations, and even introducing global exposure across the board, and what that means about getting wider than just the S&P 500. So again, incorporating more risk there beyond a headline index. So that's one way. And then you and I have talked about it many times on Rock Talk, what private markets can do for client portfolios.
Yeah, those private market pieces are meant to have a non-correlated piece to the market, and it's less emotional.
Yep.
And they don't reprice second by second, right? Typically on a quarterly basis if they do. And with that, it helps to smooth out those ups and downs and help to insulate that portfolio over time.
And it's funny, you and I in client meetings have talked about this quite a bit, and usually we're trying to not persuade, but just relate to clients why you need all these different tools and why you don't just need an S&P 500 index fund. Well, it's for times like these. Even going back to what we're doing in the public market space, we've always advocated for a healthy mix of not only passive exposure to public markets, but active exposure to public markets, because we do know that there are times where markets don't make sense, and there are really talented men and women out there watching markets that can spot those just individual moments where they see a mispricing and they can take advantage, and our clients can benefit from it.
Yeah. And And when we look at this, something that I have been bringing up and we talked about also at our client event this past Saturday, which was if we go back 2 years, March of 2023, this is the most volatility, the most ups and downs we've seen in the market, or the biggest sell-off that we've seen since March of 2023. And I asked everyone, and we're sitting there in a room with
Crickets.
nearly 200 people, and I asked
Crickets.
everyone, what caused that 2 years ago? It was
Well,
silent.
I know the answer
You
now.
know the
but-
answer, yeah.
But
yeah.
it was interesting.
Yeah.
Well, even when you asked that question, I really had to think about it because I mean, let's think of it. We as human beings, we're really incensed in the moment and thinking about what's either right behind us or right ahead of us. Sometimes it's a lot harder to think in terms of months and years.
Yeah, and that's absolutely right. I've always looked at this as the discussion that I have with clients. Generally, it's difficult for them to think back more than about 12 months and quickly recall what has happened in the economy and the market.
Yep.
So when we go back 2 years, much more difficult to recall.
Yep.
And what happened back then? It was when Silicon Valley Bank collapsed, right? And we were all concerned, is that going to cause a domino effect within the rest of the banking industry?
That was a real concern.
It was.
It was like deja vu over again.
Yeah, it truly was a real concern. It was legitimate, and it caused a lot of panic. And when we're looking at the tariffs and everything right now, and the results of that, the uncertainty, that's what it's causing, right? How are things going to play out? How much longer are we going to continue down this path? Are we going to quickly, reverse and start heading back up? Because there's been a big sell-off in the Mag 7, and some of those stocks that have really pulled us along might be a nice buying opportunity on some of those.
It definitely could be. And again, that's why we need some active managers in those allocations to make those decisions for us. Even putting some continued context on where we are currently. Everyone knows the VIX. We talked about it earlier.
That's a volatility
Right.
controlled index. So,
Yes.
right. So it measures volatility in the market. When things are going like it is right now, that index
It's
shoots
going to
up.
shoot up.
When things are smooth like a lake, right?
Yep.
It's pretty calm, right? But
Yep.
what it's done the last few weeks is it's shot up, right?
It shot up, and it looks at option pricing going out 30 days. There are a few other measures out there that we look at here at EdgeRock. One of them is just the Core 1M, and what this measure looks at is the correlations between stocks within an index. So what this means are all stocks going up and down at the same time. And to tell you the truth, and it gives credence to, despite some of the ugliness and the sell-off that we've seen so far, knock on wood, this has been relatively orderly because we haven't seen just this massive jump in that measurement yet. If this was a pure panic moment, we would see both of these measures skyrocket all at once. Not to say that that couldn't potentially happen, but again, goes back to what we had said earlier. There's really nothing that we've seen as of yet that's out of the ordinary or cause for real concern. Again, not trying to predict the future, but as of right now, this is just markets being markets.
That's right. And if we look at those 507 stocks that make up the S&P, just a little more than half are down on the year, and the rest of them are still up.
Yep.
So again, to your correlation, this isn't pulling the entire market down. These are areas of the market that I think as we look at it, we go back to 2023, 2024, we had 2 great years in the market. We'll take those any time. You have tariffs, causing uncertainty, that piece of it, and maybe some soft economic data coming in. But on top of that, we also have a market that maybe was a little overheated, and we needed a pullback.
Yep.
Right.
Just a healthy market function. I agree.
Yeah.
And I think every other financial advisor and market pundits would agree with that as well.
Yeah.
Maybe moving forward a little bit, I mean, do you want to discuss about, well, what does this mean for our clients? What does this mean for allocations? And even though we really don't like predicting the future, we can use our experience to kind of, I guess, put out there what could happen and what's maybe reasonable expectations going forward for this year.
Sure. So, it depends on the model that you look at and who you talk with. You have financial advisors going on TV or, the pundits out there. You hear anything and everything on the market. The market's going to finish the year up. The market's going to further down, you get everything, every story. So it's really tough to decipher just that information, the noise that you hear on TV. So you and I have always stuck to what's the data say,
Yep.
right? And we feel a lot more comfortable with that versus just guessing and listening to some talking head on TV. So, with that, I think and maybe taking half a step back here, and one other thing that from a client perspective, if I'm looking at things right now, with a lot of our clients, we do a lot of Roth conversions. We do millions of dollars a year in Roth conversions. And that might be something that if someone is looking at doing a Roth conversion, those IRAs are down right now, right?
Yep.
And
convert at a lower value.
Yeah, if you convert 100,000 now versus you did 100,000, you would have done 100,000, let's say a month ago. You're converting a greater percentage of that IRA, and so that might be something right there that our listeners could look at. If they want to go ahead and execute that now versus we usually do it in the fourth quarter of the year. That's something that we could take care of and take a look at and go ahead and do that now. And that might be an advantageous area right there.
Yeah, there's no reason why downturns can't present opportunity. That's a financial planning opportunity, absolutely. And it could present some active managers some opportunities as well. I think that was a great point. I think where my head is going, and this is something that I believe very much in here. I've told clients if they're properly allocated, we've paid attention to what their risk, to what their goals are. We've paid attention to what their risk tolerance is. Hopefully, we've designed a proper allocation in which they're not really too concerned about what's going on in the market because they know what we've designed here can accomplish their goals over any market cycle. Yep. And I believe that if we're at the point where we're really starting to question things here, unfortunately, it means that we didn't pay good enough attention to those two things on the front end. And I'm happy to say that we don't have a lot of those conversations, if any.
Yeah. I always feel very confident, when we do sit down with a client to review their portfolio or have a conversation if they have concerns about the market that portfolio lines up with those original expectations in terms of their comfort level with the risk in the market.
Yeah, it's it's investment 101 that your overall allocation is going to generate 90% of your return. So if you're really trying to swing back and forth between fixed income and equities, you're taking a little bit of a risk there, where the results of being wrong are going to be greater than your benefit of being right.
That's right. Bouncing around rarely helps. Maybe speak a little bit to, when it comes to treasuries and bonds and where those are at right now and what our outlook is. I know we've hit on this a little bit on Rock Talk here recently, but we've seen interest rates come down.
Yes, we have.
We've seen the yield curve right itself for the most part. And then, every couple hours it'll invert a little.
It was funny because I remember in one of our conversations, we were talking about the biggest risk was the 10-year going to 5. And now it's hovering kind of above 4. So it just goes to show you that, truly the future is unpredictable. So without getting too technical about the curve, fixed income is going to be an important part of any allocation, again, depending on what your goals are. I think what our listeners want to know is this going to be another 2022 event in which we get this positive correlation between two asset classes that are supposed to act differently?
Stocks and bonds.
That's right. Yep. Yeah. And to tell you the truth, it's unknown. But what I would say, I'm more comfortable at least guessing that I think fixed income is going to act more like fixed income and be a ballast to an equity position in a portfolio because there's a yield component to what everyone's holding there. No one's going to immediately go sell an instrument in which they're receiving 4 or 5% annualized income versus something that they were holding in 2021, 2022 that wasn't yielding anything. So I would expect those prices to hold up more favorably in this environment than they would in the past kind of bear market that we saw.
Yeah, agreed. And that should give everyone a little, allow you to sleep a little bit better at night, that piece of the portfolio should sustain itself better versus 2022 was a bad year in both stocks and bonds.
That being said, I know most of our listeners are going to think, oh, well, Wyatt, I'm listening to all of this, and your conclusion is, let's stay put and let's really let our allocations ride. Yeah, I think that is probably the best decision 9 times out of 10.
Yeah, it is. And most of the time it is, right? Warren Buffett, quoting him, a little bit more, but the stock market is a device for transferring money from the impatient to the patient,
Yep.
right? And I think the more patient we can be and let these things play out a little bit, we find that in the long run, we come out better. And at some point here, it could be this afternoon before the 2 o'clock close of the market, right? Or it may be a month from now. I don't know when that's going to be, but at some point the market is going to work on righting itself and start bouncing back up, and there's going to be a nice opportunity there for those gains. And so we don't know when that's going to hit, but at some point it's going to right itself. And we always want to be on that side of the equation to ride that back up. And so, when we look at this, I think another perspective of this that I think really helps is the last 4 months of 2024 that was a great run up in the market. It was really, really nice. Right?
It felt like it was straight up. Every single
Right.
day we were coming in and everything was just green.
Yes.
Not to say that was not fun or great,
no,
but
love it,
I mean,
right?
you knew that wasn't going to last.
Yeah. As much as I enjoyed it and I love seeing that for our client accounts, it also at the same time behind the scenes, it causes me a little angst wondering, okay, when are we going to go back? When are we going to pull back?
Yep.
Right. And so when I look at this, and I think this perspective might help families. All the families that we sat down with last year, virtually, 99% of them, their financial plans look great.
Mm-hmm.
Okay. And they looked great a year ago. And really what we've seen is this pullback kind of takes our values in those portfolios back to what was the end of last year, maybe let's say August, somewhere around there. It takes those
I
values
think that's
back
right.
6 months, maybe 7 months or so, where everyone still looked great, right? So understanding it's a pullback, but it doesn't change things. A year ago, your financial plan looked great, and it probably looks exactly the same right now.
Agreed. We stress financial plans and allocations for moments like these, and it could get worse, but I would still imagine that the vast majority, if not all of our clients, are going to be in a great spot no matter what.
They are. And we're going to continue to pilot the plane and keep moving along. And, I love the team and the research and everything that we do on our end. And again, I can't emphasize it enough. I think there are a few key points for families that I would summarize, with is, be careful about how TV, social media, emotion, plays into just, what's going on a daily basis and maybe how you feel, right? Get out and go take a walk, put the phone down sometimes. It's easy to just scroll. And TV and social media are meant to keep you engaged. They don't do that by being boring.
Yep.
They do that through the flashy headlines. Things are bad. You never flip on the news and it's rarely rainbows and unicorns.
Yep.
It's always crash headlines and so forth, and that keeps you engaged. And so we have to be really careful about how that emotionally gets us going, right? So go to the gym, go for a walk, go for a hike, and bring that, angst down a little bit.
I would agree. The other thing that maybe I'd point out in some of our concluding remarks, in financial jargon, what everyone is concerned about is tail risk. What's that 5% chance that this ends up in another '08 like style recession? You can't base your decision and judgments off of tail risk. You have to acknowledge that it's there, take it into consideration, and have some idea how things might look like if indeed we do take that tail risk. But when you look at the grand scheme of things, and when you look at a normal distribution, and we can have debates of what a distribution should actually look like for events like these. But anyways, there's still a base case out there that says that things over the long term are going to be just fine. And we shouldn't just use this adverse event to base all of our decisions right now today on. And that's something that I think about every single day. I acknowledge the tail risk that is out there, and yes, it could potentially come true. And what events like this, I think, or I should say, what sell-offs like this, I think, really mean to people like us, right? Does it mean that maybe that tail gets a little bit fatter or a little bit wider? Yeah, sure, maybe it does. But again, at the end of the day, I can't base all my decisions today on that probability that things are just going to go completely south.
That's right. That's right. And businesses, they adapt and they grow. I would say stick with the trend, not the headlines that are out there. And that we've got a little bit of a trend here, but we'll continue to watch it and monitor it and so forth. And whenever we're running scenarios with our our financial plans, we always run that through a pretty hefty stress test on someone's plan, right? We have the ability in our software to go in and test it and say, okay, what if a 2008 happened again, right? And most of the time, the financial plans, they hold up really well. It does pull things back, but in the long run, the client, it comes out.
We're considering it, but we're not basing our entire decision-making process on it.
Right. It's always there. We're always looking at things, but we can't completely change things just for that small percentage that, hey, this may happen and it may go down 30%.
Yep. Moral of the story, well-designed and thought-out financial plans and allocations tend to survive over any market environment.
That's right.
It's boring, it's simple, but it's true.
Can't emphasize that enough. That should be put up on the, a plaque on the wall. That's exactly right. So, yeah, I think keep going as we have. Keep the financial plans in place. We're happy to connect with families, and you want to come in and talk about the plan a little bit, make sure that everything's allocated the way that you wish.
Yep.
Which we had those conversations on the front end, so we should be fine on that piece. But the financial plan, having that entire plan in place, it's meant to withstand this. That's exactly right. So, the concern isn't there at this point, and it's not hitting the broad market. It's, it's more of a micro, maybe not quite micro, but more focused areas of the market that have been hit. It's not a broad piece where the entire market's coming down and being hit.
Yeah, and we'll see if we get there, but at least with what we're seeing right now, nothing necessarily out of the ordinary.
Yep. So here's what we'll do. Hey, everyone out there, this page, like and follow us if you will. We're going to continue with Rock Talk and hopefully bring you some, just great insights as we continue to move along. Let us know what your questions are. Email those in. That way, next time we come on, we're answering those and keeping you updated on what you want to talk about. And we'll see you on the next episode of Rock Talk.
Yeah, looking forward to it. Thanks, Kyle.
Thanks, Rob.